Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. Generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look, and see what people are sharing. If you want to follow me at _finance, and if you want to join our community, findingvalue.com, where I dive deeper into all these topics and subjects, looking for investment opportunities and sharing them with everyone in the community. We still have a special coupon code that is active for both the monthly and yearly membership. It is a larger discount on the yearly membership. So, starting off with Jorge, he says total U.S. oil inventories excluding natural gas liquids, propane, butane, etc., are declining and are lower than last year, even if WTI price isn't reflecting it. 1.4 million barrels, down 2 million versus last week. And there we are in our total U.S. oil inventory, excluding natural gas liquids. This is pretty low. You can see the average of 2013-14 is up here. The average of 18-19 is up here. So we are way below in inventory across all these different areas. And you know what's kind of weird? We have lower inventories across everything, but yet we've got way cheaper pricing. It's a pretty large disconnect of where inventory levels are at and where the price of oil is currently trading. So, I mean, that's the big question mark. Why is there such a big disconnect? I don't have the answer for you. Is it a demand destruction event coming? I mean, most events, guys, it doesn't really destroy demand. Um, it takes a lot of deleveraging or deflation to actually kill oil demand. If we just get a slowdown, demand generally goes up under a benign slowdown in the markets. So that's where we're at. That's where we're located. We've got low oil price and low oil inventories. Nas says, you were told about 2 weeks ago that OPEC plus crude oil supply declined in April despite the announcement to increase production in April. Today, we got the confirmation from OPEC. It did decline. Daily energy report. So OPEC crude oil production declined. And what did all those pieces of information and news come out? Well, they all said that there's going to be an oil glut and that they're going to get into an oil price war, I believe is what some articles had said. Um, guys, remember I came out and I said this could potentially be fake news? That's where it's at. Potentially could be fake news. Be careful what you listen to in the news that you're reading. I am becoming very doubtful and suspicious with everything that I read now. Everything. Um, I read a lot of stuff, and it's like, man, I don't know if this is true. I think it's all jawboning, trying to get the price of oil down. But we saw, we're seeing the inventory levels; they're all super low. Who's right? Is the market got this wrong? If the market has this wrong, we've got the best buying opportunity probably of any time in history in oil. We have inventory levels that are lower. They are lower today than $150 per barrel oil in 2008. And we have far less days of coverage. The only thing that's different between then and now is sentiment. It's news. It's whatever's being floated out to the general public and what they're reading and what they're being manipulated perhaps by. That's the only difference. Here's the oil to gold ratio. I like my oil. I get my oil in, right? This is history going back to the 1950s. Cheap oil, like 73, would have been a good time to buy. 73, 85, 88, mid 90s here. Then we went into a very expensive era. We have a falling wedge, breakout, and another falling wedge with a false breakdown ready to turn and move on higher. This is coming from a ridiculously low level where crude oil is vastly underpriced. You can see the dotted line going here. That's where we're currently at. Only one time in history has been cheaper, and that's 2020. Right now, this looks pretty good for going long in oil for I'll say the patient investor looking for value. Looks fantastic. JC Parrott says, taking off arbitrary moving averages from my charts has helped me tremendously over the years. They're mostly just a distraction. Yeah, a lot of people ask me when I chart, if you notice on all my charts, there's no moving averages, there's no relative strength indicators, there's no MACD, there's none of that crap. And the more advanced you get, the more you go away from all those indicators. They're kind of like, in my opinion, the beginner. It's like when you start first charting, you start using the MACDs, you start using RSI, use chalk and money flow. There's other things that you can use, Bollinger Bands. Yeah, it's all a waste. That's what I found. What you want to find is you want to find repeated patterns. You want to find patterns that are deep into the charts. That's an extension of the psychology of the herd. And then you want to look and see for expansiveness and contraction in the charts, is what I've found. So everything else is just a distraction. And this is JC saying this. And I don't know JC, but I totally agree with them. I think that's the moving averages and all that crap. It's all just a distraction. And I would also say that trading in the short term too it's pretty tough, and your success rate is pretty low. So those that are really good generally size up big moves. Those that are, I would say, more that are newer and haven't figured out that you can't really predict or time the short term, they use all that crap. So that, I mean, that's my opinion. I don't think you can guess or get right the short term market movements on a high enough percentage basis to make it worthwhile, in my opinion. Also, once you start to clear certain levels of, say, net worth or account value, it becomes harder to try to trade because you're not going to put all your money in a single trade or two. So that's where trading it's limited, and I wouldn't do that. Sizing up the big move, finding undervalued companies, and then deploying across in a way where you've got strategies. I mean that's kind of where I live, so to speak. This is Brandon. He says top in Bitcoin. So just in, Dave Ramsey's show flips stance on Bitcoin. Bitcoin has arrived and it's here to stay. It should be part of a diversified strategy, according to these guys. Um, a lot of people, I'll just say this. A lot of people justify Bitcoin and why it is so good because the price has gone up. So price is driving narrative. And then they'll say, well, the price has gone up for a long time. Therefore, Bitcoin is good. Um, the way that I would fight that is that I don't want central bank digital currencies, and I think that they're hurting the masses into this. And I feel like it's just a bunch of sheep going in to get slaughtered. And I could be wrong. It's fine. And I can make my money through other ways than crypto. I just think that the design of Bitcoin is garbage. If you listen to most people that like Bitcoin, ask them about another cryptocurrency outside of Bitcoin. And what is their response? Their response is, oh, that crypto's crap. Oh, it's not Bitcoin. Oh, it's garbage. You can apply all of the same logic that they use to apply to those other cryptos against Bitcoin and come to the same conclusion. That's all I'll say. Shabam says distillate inventories are at 20-year lows as America continues to destock and run close to operational minimum. Rising crack spreads, which is basically gasoline margins, rising crack spreads will eventually push refineries to run harder, increasing oil demand and pulling down crude oil inventories, all while U.S. production is flatlined for oil. So U.S. ending stock of distillate fuel oil is heading towards lows and potentially could break lower. If that breaks lower, your crack spreads blow out, and refineries are incentivized to produce more distillate or gasoline or final products. So it'll just yank and pull on oil to feed the system. Sven Heinrich says, so how's the debt refinancing going? Here we are with increasing interest rates running higher on the 10-year yield. Vicent says he's going to hold the 4.5-ish% line. 4.5 to 5% line is what he said. We'll see if it happens. If he holds the line, he just transfers pressure into the currency, so the currency will decline. Here's money wisdom, the problem. If you're a high-income earner, 165,000 adjusted gross income for singles, and 246,000 for couples, you can't contribute to a Roth IRA directly, which means you can't get tax-free growth from a huge wealth-building account unless you do the backdoor Roth. The backdoor Roth is contribute to a traditional IRA, convert those funds into a Roth IRA immediately. You can do it that same day or week of conversion. This allows you to still get your contributions in, and the backdoor Roth is allowed by the IRS. Another thing that you can do, if a lot of people who make over this amount are generally self-employed, you can open up a self-employed 401k. You can put money into a 401k either pre-tax or after tax. After tax is a Roth 401k. That's where you can put a gobload of money in. So you can still do this IRA conversion each year, but it's limited to, I think this year is $7,000. If you get a 401k, you can pile into a Roth 401k if you like, and you can do partial pre-tax, partial post-tax. And that's what I do. I try to put as much as I can into a Roth 401k. The maximum amount of 401k contribution for an employee and an employer is $70,000 per year. And if you dump in a whole bunch of money into a Roth 401k, that can grow tax-free. But most tax advisors would say it's good to have both pre-tax money and the post-tax contributions that earn tax-free. So then you can draw from both accounts in retirement, and you can get up to, I think it's $96,000 taken out without paying taxes if you are married for a couple. Slogans don't drill wells. Presidency to date percentage change in U.S. oil production. So Trump 1, Obama 1 and 2, these are your production levels, and this is Trump 2 down 0.7% for production. So drill, baby, drill. It's really deplete, baby, deplete. I don't think it's necessarily his fault. I think it is more to do with the geology of the wells and the price. Now, if he's in there jacking around with the price, well, then it is his fault. Prices are too low to increase production. And in fact, if geology is constrained, prices may not increase production of shale oil. So we'll see if they're geology constrained, and that's what I'm betting on the long term, is that shale oil is geology constrained, and that U.S. oil production will decline over time. And that's my bet, irrespective of what the price is. It's geologically constrained. Go back and look at the 1970 peak of conventional oil. That peaked in 1970, has never even come close to going over that peak of just conventional oil. Are there other oils out there that we can maybe produce from other fields? There's tight oil. I'm not as positive on that because your energy return on energy invested is dramatically lower on some of those areas. A lot of people will say it's price driven. I don't think it's price driven. I think it's energy return on energy invested driven. So there's no point of getting something out if you expend more energy. Well, I mean, you could. The way that you would do that is if you had an abundant source of energy and you wanted to convert it to oil. Oil is more or less just a battery. So oil is a battery, it's stored energy in the earth. So we're mining stored energy out of the earth and converting it into usable products that we can burn inside whatever. Or we convert it to paint, we convert it to lubrication products, we convert it to plastics, all sorts of different things. So it's the Earth's way of creating these huge energy stores that we extract out of the world and convert to different things. That's all it is. Coming down, the dumbest part of this fiasco with China for the past 30 days is that we waited long enough to allow China to raise prices before we de escalated. Guess what Temu and Shein are about to do with their 115% reduction in tariff rates? They're about to pocket that difference as pure profit. Companies never lower prices. Not only did we achieve zero and have to predictably back down, but we also just permanently increased the price of many Chinese products. Good game, everyone. 8D tic-tac-toe. I don't know. I mean, I don't really buy a lot of stuff from China. I'm sure my wife does. I'm sure she buys clothes from there or something, if I can remember. My clothes, I don't even know where they come from. I just grab some no-name stuff, throw it in the cart, go to checkout, and get the heck out of the store. I don't like buying stuff with stuff on it. I usually have just blank T-shirts, and that's kind of that's where I live, man. I don't care about this crap. There's a bunch of Chinese project products. Most of it's just garbage. Doesn't even matter. I get mad at my kids and maybe my wife if they buy some of this crap. I mean, it's just going to end up in the garbage anyway. So why buy it in the first place? Anyway, Warren Buffett, leverage is the only way a smart guy can go broke. If you owe money and you can't pay it off, just pay for everything. Do smart things, and eventually you'll get very rich. So when you try to decrease the timeline to getting rich, that's when problems occur. Is when people borrow money and get in a pickle. The U.S. government now spends more money on interest payments on the national debt, 1.11 trillion, than it does on national defense, 1.10 trillion, per Charlie Bellello. Well, it's probably going to go up if the interest rates go up, right? This is going to look pretty nasty if interest rates go up a lot and we roll over a bunch of debt into those higher interest rates. Speaking of interest rates, back to 7% mortgage rates we go, despite the trade deals and lower inflation. I don't know what that even means. The second portion. So, how are mortgages related to trade deals and lower inflation? I think we've got these things backwards. I think the mortgage and interest rate market is forward looking and they think inflation is coming. So when I read some of these guys, I'm like, that trade deals, what does trade deals have to do with inflation? Not much. It has nothing to do with it, in fact. Lower inflation, no, that's an opinion. I don't actually observe anything that has gone down in price. Now, lower inflation technically is disinflation. So I have seen disinflation. So that is true. But I haven't seen lower prices. So I've seen the rate, I think, decline. So the rate of increase of pricing has definitely slowed down, but I haven't seen prices actually go down. There is nothing that I buy today that is cheaper than, say, 2 years ago. Nothing. Everything I eat, which is mainly everything I eat, everything I buy is mainly what I eat. I mean, that's mainly what I purchase as food. And most everything else, I don't really buy a ton of stuff. Really don't. I live like a monk, I guess, kind of. But I don't have the desire really to own crap. I'm pretty, pretty happy with where I'm at. Put it that way. I'm pretty content, if that's the right word. Content. Said content. So yeah, that's what I say there. Make oil great again. Well, yeah, with these prices down here, it will. It'll go back up. Here's the EIA inventory move. So basically, we built on crude, but we took the same gasoline distillate out on the back end. So it's really a draw of about 200,000 barrels is what I see as a draw. Peter Schiff says all the big gold and silver sell-offs on no news happened during the early hours of U.S. trading. This is not a new phenomenon, but it has been the case over the entire bull market. This supports the view that gold has been moving from U.S. to foreign ownership. This is a bad trend. It is a bad trend. Howard Marks says asymmetry, which is better performance on the upside than the downside relative to what your style alone would produce, should be every investor's goal. A preponderance of gain over loss, not avoiding all chance of loss, says Howard Marks. Walter Deemer says the New York Stock Exchange all issues advanced decline line made a new high today. This is not bearish. Not bearish, according to him, which, hey, I'll take it. Plaquemines LNG receipts were revised upwards last night to a new record of 2.66 billion cubic feet per day, which we confirmed again with a manual inspection of the Gator Express EBB just to be sure. That is on the high end of where we expect them to flow, with 12 blocks cleared for gas flow, implying total feed gas flows 221 mmcf per day per block. So there's Plaquemines, and then you can see when this came online in 2025, it's been ripping, or 2024, late 2024, early 2025, it's been ripping the entire way. Just ripping. Brent futures, dry bulk was, Capesize was flat, Panamax was up 2%, tankers, VLCC was up 1%, Suezmax is up 2%. Grady says the present pullback is just one more brick in the bull wall. So we've got, again, he's bullish on the Huey, which is the gold bug index, to move on higher. He thinks that we could see a 1,250% secular bull for a second leg. He says it is time to revisit the upper trend line of the channel. I think it is. And that is what he thinks with the gold, silver mining companies. Got gold. Costco is limiting gold bar purchases as demand surges. The retail warehouse giant already had a 2-bar limit. Now customers can only buy 1. Limiting purchases. Yep, API, and then we went over that last time. So that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I'll see anybody who's on the website, part of the community, on Sunday at 5 p.m. Mountain Time. That's all I've got. So we'll catch you next time. This is Finding Value.